Welcome, everyone. Thank you for coming today. I'm David Siegel. Today is Friday, the 26th of October, and we're broadcasting live from Mindspace in Shoreditch. The studio audience here, let's hear it for Mindspace. Woo! We got some energy. The coffee is flowing. This doesn't work at all. And I want to thank my amazing team for organizing everything, for the video, for the breakfast, and thank Mindspace for hosting today. We're going to talk about stablecoins, and it's going to be about a 45-minute presentation. And, you know, it's about stablecoins. It's not really about money. Money is here. Stablecoins are here, pretty much. But if you have a question about what I've just said, it's fine. I don't mind. But if you have overall questions, it's better to save till the end, because probably I will answer your question, okay? So I'm going to give you kind of a guided tour of the stablecoin space today. The first question is, why do we need stablecoins? What would be the purpose of having stablecoins? It's a big deal. We're going to need them for what? Well, for buying things, right? You don't want to buy a house with Ether, and you don't want to sell a house for Ether. Right? You don't want to be on the receiving end of that. You don't even want to necessarily sell a t-shirt and receive Ether because you're not interested in the currency risk of that transaction. So we need it for as a unit of account. We need stable coins. We want it also for lending, for smart contracts, for all kinds of transactions, derivatives, and many other things we're going to need smart contracts to do. Also, we want cheaper transfers and payments without the banking system. We could just use blockchain. That's what it's for, right? But paying in Bitcoin is a bad idea. So first of all, it's pretty clear that Bitcoin is not very stable, right? Except if everyone would just price everything in Bitcoin, then it would be amazingly stable, right? So the definition really of money, and you can think of it for stable coins as well, is that it's whatever your landlord would accept in payment of rent. Okay, if your landlord will accept it, it's money. And if your landlord will accept Bitcoin, that's fine, but we don't think too many landlords are going to be accepting it. So we will need something that is more stable than Bitcoin and that Ether and most of these native cryptocurrencies. So I'm going to start with a thought experiment. I've dreamed up a coin called the George Soros coin. It's one Soro. It's an imaginary thought experiment. And it doesn't exist, but this coin is backed by George Soros. And how does that work? Well, George has said he's going to pick a target price. Let's say the target price is $1 for the sake of argument. And George is willing to make coins for nothing and sell them to you for $1. So that's called a sell wall. He's willing to sell anybody who wants this coin. He'll make one for less than a penny and he'll sell it to you for $1. So that's called seigniorage. He makes $1. Right? But if then these coins are trading on the market and the price goes below, say, 99 cents, then he offers to buy any coin for 99 cents. So he's always a seller. He'll make new coins and sell them at $1.01, and he'll always buy at 99 cents. Now, this coin is remarkably stable. As long as what? As long as George is committed to the buy wall. Right? What makes this coin work is the depth of the buy wall. Can you see that? Because if George is committed, and everybody knows George is committed to buying at 99 cents, then they will feel good about holding dollars in Soros coins. Okay? If George signals that he's less committed, or he only puts up, say, a few $1 million, then that's not so stable, because people fear that there might be a run. So we know, though, from game theory, that the more George commits, if George would put up, say, $20 billion into the buy wall account, the more he commits, the less he actually has to spend. All he needs to do is put the threat up there, and people will believe it, and the price will not drop below 99 cents, as long as the commitment is there. And that's why someone like George Soros or Bill Gates or Jeff Bezos could actually start a stablecoin in the real world in this way. Now, we don't have that today, but we do have other things, and this concept is going to come back. So first thing is that these are not money. The stablecoins will not be money unless they are backed by real money. Anything that is stable but is not representing $1, a pound, or a euro, or yen is not money. It may be a stable coin, but it's not money. So we have some very important mechanisms. First, and we've just seen it, you need a way to feed in the desired price level. You need to add more coins when demand increases. That's easy. You just make coins out of thin air and sell them. So that costs almost nothing. That's trivially easy. Here's the sticking point. You need to be able to remove coins from circulation when demand decreases, or you need to be able to buy them when the price drops. It's roughly equivalent, okay? So I'm going to illustrate this. If the market cap of your collateral and the market cap of the stablecoin are the same, you're in good shape. People believe that the collateral will back up the coin. The coin represents whatever the collateral is, okay? It's a stable situation. However, if the price goes up, if the price goes up, it's no big deal. Make more coins. We've seen that. If the price goes down, now we see a situation of less demand. We've got lower demand for the coin, and that can turn into a falling knife, we call it. That can be a crisis of confidence for your coin, where the collateral isn't doing its job of stabilizing the coin because people don't believe that the price will come back up. And this is the problem. That's why George Soros's commitment makes such a big deal. So in less collateralized coins, we use monetary policy to do this. And if you think about it, what is the dollar? What is the pound? These things are completely uncollateralized, and the only thing they have going for them is monetary policy and belief. You can't exchange pounds to the government to get something back. It's only pounds. They really are like cocoa beans. They have no intrinsic value. It's just a belief system. So this is how I think of stable coins. I think about the collateralization, and then what's underneath, and then the policies and so forth. So we're going to break it down today into these categories. We're going to first look at collateralized, fully collateralized stable coins. All right, now you can collateralize with whatever you like, whatever people feel is that they're willing to invest in. You could have cash. In that case, it's money. If you collateralized with money, the coin is money. You could collateralize with crypto assets, gold, real estate, other commodities, oil, things like that. But the goal here is fully collateralized. That means the value of your collateral is always the same as the value or more than your market cap. So there's different ways to have fiat coins, and we're working on one at Pillar that I'll explain later. And it's pretty easy. You just manage the coins in circulation. As long as people start cashing them out, then they will remove money. And if people put in money, then you'll give them coins. So fully collateralized doesn't require a monetary policy or this buy wall at all. It's just that you put 100 pounds in, you get 100 pounds worth of coins. You redeem 100 pounds worth of coins and you take 100 pounds out. This is the goal of many projects like USDC from Coinbase. And Tether is one, we'll see it later, that's supposed to be collateralized more or less in this way, although it's a big mystery and no one really knows. So this is what Tether looks like. Tether has recently, about a week ago, had a bit of a shock to the price because of some bad news. But look, there's kind of a natural spring that brings it back. And right now, today, this morning I checked, it's 99 cents for one Tether. So if you had bought a whole bunch of Tether back in January, you'd be pretty happy, right? Because most of these other coins, most of the crypto coins have dropped, but tremendously. So compared to Ether, even if it's dodgy, even if there's risk in Ether, there's risk in Bitcoin, right? This is looking pretty stable. It obviously has some times of uncertainty, and it's a black box. We don't know much about Tether. But just performance-wise, this is the largest stable coin in the world by far. This is over $2 billion in Tether. It's actually not too bad. And I don't think it's a scam, and I don't think it's a disaster. I think it's just a wacky thing that doesn't have much transparency, but I actually think it's a fairly stable coin. This is the new Coinbase coin that just came out about a month ago. And look, it's actually pretty stable. And when the demand goes up, it's easy. They just quickly make more and it goes right back down. But you see there hasn't been any panicking here. And the goal here, of course, is that $1 in, 1 token out. So every token represents $1 in. And they give you full transparency. You can see in the bank balance at all times. And so this should never really deviate very much from $1, right? If there's more demand, if demand spikes, they just have to quickly make tokens and that'll bring it back down. We don't expect demand that the price will go down because you can always see your dollars in the account. And other people, for example, are working on one with Swiss francs in a bank vault. The actual notes go in a bank vault and you have a claim. So in case the company is destroyed or the world is destroyed, there's still some Swiss bank vault where you can go with your tokens and get your paper Swiss notes. There are a bunch of issues, and to me, obviously transparency is a big deal. To me, the big one is liquidity. So if we have tons and tons of stable coins, that's not going to work because we won't have enough liquidity. Liquidity means that there's an active market for these things, and that helps support the price. There are many other issues, especially regulatory, that I'll talk to you a little bit later. Now, crypto collateralized can be fully collateralized. We're still at where the gas tank is still full. So we're looking at fully collateralized coins, but they could be crypto collateralized. And the idea there is if you want to get $100 worth of tokens, you'd put in, say, $200 worth of Ether. And that's more or less what happens with the DAI token. And you can see the price of the DAI token isn't too bad. Look, this is 97.5 cents. So it's actually in that range. It's got maybe 5% up and down, but it's pretty stable. And if you put $200 worth or pounds worth of Ether into the smart contract and get $100 worth of DAI, what happens when Ether gets cut in half? Now it's not so fully, now it's just at the edge, and if Ether goes down more, it's no longer fully collateralized. And that's the point when the smart contract will trigger and you'll get your money back. And in this kind of a coin, in a crypto collateralized coin, there's always a second token that offloads the risk. So there are other people taking the risk. Now, the one thing no one ever talks about with these second coins, these two coin systems, is that this is a security, right? This is a bet that some investors are taking. In effect, these investors are George Soros, are replacing George Soros. They create the buy wall. So when the price goes down to 97 cents, there's a bunch of investors who say, well, heck, I'll take that because when demand goes back up and it's $1, I've made 3%, and I might make 3% in 5 days. So there are speculators in the market who will take the other side of that bet. And again, it's about the depth of the buy wall. If there are enough speculators who take the risk side of that trade, then when it bounces back up, they'll make money and it's a good deal for them. And the stable coin holders will have a stable coin. And this looks like it's actually working pretty well, right? A few moments of sheer terror, but in general, it's working. DAI is working. The problem with DAI is that these people, the people who own the risk token, which again should be categorized as a security, but somehow magically isn't a very good investment. And so here's the price of Maker, the risk token, over time. And you can see, first of all, it's been a crappy investment as Ether has gone down, because more of these contracts have unloaded and they've had to pay out. And it hasn't outperformed Ether at all. This is the price of Ether. And so if it isn't better than Ether, then why are you in this market, right? Why are you buying the risk coin if you've got the same risk as just owning Ether? So in my view, the Maker experiment has failed so far, only because the George Soros people, the people behind the risk of that coin, have lost quite a bit of money. And I don't know if you can now encourage a bunch of people to jump in there and take the other side of the trade and spring the price back up. Again, it's working right now. The price is pretty stable, but I don't see it very scaling or lasting very long, really. And that's probably true with any crypto collateralized. Why? Because the volatility is just too high. There might be people who could figure out how to make money in that environment, but if it goes down and down and down and the knife drops, it's hard to make your money back. So now we have fully collateralized, but asset-backed. You can back your coin with any number of things. I know some guys who are backing a coin with diamond making time, a minute of time in a diamond factory to make synthetic diamonds. You can back with all kinds of things. I've heard of coins being backed by cement, by zirconium, by all kinds of things. And you know, it's always the market value of that collateral that forms the floor price of that token, right? So here's Digix Gold, one of the oldest so-called stable coins or commodity-backed coins, and it's performed pretty well. This is actually just this year, but it's been out for almost 2 years, and it's been pretty carefully, closely matching the price of gold, which is pretty good. And the reason, of course, is that they say at least that there's a gram of gold in the vault for every token you buy. And if that's true, and people believe it, then it should be fairly stable. And if they can prove it and show the grams of gold are there and there's an independent audit, that's even better, right? Because you want to make sure that people know that you are fully collateralized, right? So if there's any doubt about how much gold is actually in the vault, that is the degree to which people the price might jump away from the price of gold. So that's fully collateralized. Now we'll drop the gas tank and say that we're only going to do partially collateralized. And in that situation, remember that your collateral is less than the market cap at all times, and it's supposed to be. And this is what we would call a reserve system. There are reserves. The reserves form the floor price, and somewhere just above this market cap price, it might spike up, but then you just make more coins and drop it back down. So this isn't going to go too much above, but this is the floor price, and this gap here is the belief that the coin is going to stay stable, right? This is the belief system here. There are a bunch of projects like this. I know actually one that's quite interesting, and I can tell you this has two important parts. One is, what is the collateral? If the collateral is some kind of crypto coins, probably bad. But if the collateral is cash or real estate, possibly, that's a lot better. And then the monetary policy. What is the monetary policy? What is that natural spring that brings the price up when there's a crisis of confidence? And then and there are not very many super successful semi-collateralized, partially collateralized, but I don't think these will be money, but I do think that we'll see several of these. There's a new one I know about but can't talk about that I think will end up as a store of value. They won't really be a unit of exchange and you won't pay for things with them, but you can store money there and it will be a good store of value. I think that's a good use case for this kind of thing as long as there's serious, real, valuable assets in the collateral. So now uncollateralized stablecoins is where it gets interesting. And remember, the Soros coin is uncollateralized. There's nothing there, just the willingness to back it up, back up the price, right? And the same with Tether. Well, no, I'm sorry. Tether is collateralized. But the dollar and the pound and the euro, these are all fully uncollateralized. There's nothing behind them, right? So it's a legitimate.
There is gold in Fort Knox.
It doesn't back the dollar. There might be gold in Fort Knox, but it doesn't back the dollar. You can't go to the Treasury and say, give me my gold. They're completely, they separated in 1971. There's nothing behind the dollar. The dollar is a belief system just like every other major currency. It's not bad, it's just not collateralized, okay? It's collateralized by our belief, by everyone's commonly shared delusion that this is valuable. And that's it. There is no intrinsic value in a completely uncollateralized system. It's all monetary policy. Again, that's not bad. We have lousy monetary policy in the United States, lousy monetary policy here in the UK, and lousy monetary policy in the EU. But in Australia, the monetary policy is pretty good. So they have actually a pretty stable product there that doesn't cause recessions. And that's another talk I have about money, talking about monetary policy, which I'm not going to spend much time on today. So this is what we would call, a decentral bank, right? What's the deal? What are the mechanics of the monetary policy? And most of them aren't that great, but there's a kind of a newish idea that some projects are doing. Can't remember the name of it, but there's one that's. Can anybody give me the name of the seigniorage shares project? There's a couple, huh? Basis, thank you. Basis is correct, right? And there's a few others now. And the idea is, again, that there are investors who play the role of George Soros. But it's interesting because when the price goes up, what are you doing? You're minting coins and selling them. That's called the seigniorage. There is the profit you have on making a coin for nothing and selling it for $1 or $1 when price goes up. So that's a lot of profit, right? So the idea is that we could share that profit with investors who are willing to back up the coin when the price goes down. And so we can issue them something like equity in the project, and they will push the price up. They will agree to push the price up to buy the coin when it goes down, because then when it's up and you're making new coins out of nothing, that's pure profit, and they will participate in that. And that looks a little better than just buying for 97 cents and selling for $1. You're kind of giving them equity in the project, right? Just the same way that George Soros, when he makes a new coin, it's all profit for him, and if he sells it into the market. So this is the seigniorage shares concept. The problem is with seigniorage shares that the risk is a bit asymmetric, that in general in markets, we see markets, the price goes up gradually, but it can fall fast, right? This is a problem with markets. As George Soros says, these things go up slowly but fall fast. And so when it does fall fast, who's willing to put the price up? Who's willing to buy and take the other side of that bet? So if you see a curve like this, are you a buyer or are you a rat trying to get off the ship before it goes under? This is the problem with seigniorage shares. It works great until it doesn't, right? And you don't know when that black swan event could happen and the knife can fall straight to the floor. It's not necessarily bad because everyone in the system may assume that risk. And remember, if you're holding Ether or Bitcoin, you're assuming plenty of risk anyway. And so if we think that Tether or these other things or the basis coin has some risk, well, there's other risks you're taking if you're holding something else. But it's a question of who will take the other side of that trade, and will they find it profitable? Again, if you're a seigniorage shareholder over time and you lose money, you're probably not going to play that game very long, right? And so there are several projects trying this. Here we have Basis, Haven is another one, and Reserve is probably doing something similar. Now you can not only use equity in the project, but you can also sell bonds, debt for seigniorage, and you can prioritize the debt over the equity. It gets fairly involved. This is financial engineering that I'm not going to go into the details of, but it can get fairly involved, and the goal, again, is that you want to incentivize people to catch the knife and spring it back up. You want a natural spring that takes the price back up. Does that all make sense? This is kind of a new area. This is just in the last 6 months we've seen these coins. And also keep in mind that the seigniorage share, the actual share that someone's buying is a security, and it will almost certainly be regulated as a security, even though no one ever talks about that. Possibly could go to jail for selling this basis risk coin without the proper security measures, as an unlicensed security. Very possibly could go to jail. So there's definitely some risk in that area. Although you can imagine that when they get it, to be if it can get to the right scale, if it gets into the tens to hundreds of billions of dollars and there's a real market for this and it's fully regulated and everybody knows what he's getting into and hedge funds start buying that risk coin, it might work. It's just that we're not there at that scale yet. We do have some other regulatory issues. First of all, the security. The other one is money. Tether, if you buy Tether, you can't redeem Tether. Tether is unredeemable. The only thing, you could not if you buy Tether with Bitcoin, you'll never get your Bitcoin back from the Tether people. And in fact, the goal is, you can even send them cash or use your credit card, send them £100 and get your Tether. You'll never get the £100 back from them. They won't do that. You have to get your £100 back by selling them to someone else in the market, okay? Which has worked. It's not bad. And the interesting thing about that, I don't know whether they designed it this way 3 years ago or not, but without a claim on the cash, it turns out it's not money. It's like it's your risk. And because it doesn't represent a claim on cash, it doesn't have to conform to e-money and money regulations, banking regulations. However, when we're doing our coin and the USDC and many of these other coins, they will be backed by dollars or pounds, and you will be able to redeem and get your pounds back out. That's seen as money, and the regulators will require licenses, KYC checks, anti-money laundering, anti-terrorism, all these extra bells and whistles that will be required by the regulators, and that will increase the friction in the price of these products. Okay? So for the privilege of using dollars in smart contracts, we will pay a pretty penny because of all the regulatory costs. You need a way to feed in the price level. You need a way to sell new coins when the price goes up. That's a good thing. The problem comes, you need a way to remove coins from circulation or put in that buy wall when demand decreases. And one monetary policy is just to remove coins from circulation, just as the Fed does, right, when they sell bonds. And in fact, that just recently happened with Tether. The Tether, whoever owns Tether, we don't know exactly their names, but there's a lot of shell companies there. They recently put about $600 million into what they call their treasury wallet and removed coins from circulation, which again boosts confidence that the remaining coins will not lose as much value. So there are different ways to implement monetary policy, and it's critical that you address the problem of decreased demand. So this is how I sort of see this world: fully collateralized, partially, and uncollateralized. I should have dollars here. This is dollars. And I don't think any of these will be money except for this area right here. And this will require e-money and banking licensing. Okay, you may not use the banking system, but you'll have to comply with banking regulations. So this is MiFID, the money lending law, the money laws. Our next year, MiFID 5 is going to include crypto statements in the next, so I'm going to read this to you. And this is from next year's, the MiFID 5, Directive 5. It is therefore essential to extend the scope of Directive MiFID anti-money laundering and e-money laws so as to include providers engaged in exchange services between virtual currencies and fiat currencies, as well as custodian wallet providers. This is actually ambiguous language. We don't quite know what they mean by this, but we interpret this as saying that a year from now, anybody holding a token is going to have to, whoever's allowing these things to be sold is going to have control over it like it's money and do all the anti-terrorist financing and anti-money laundering and everything and know who has it. So if you think about it, in the world of stablecoins, there are going to be good stablecoins and bad stablecoins. You may hold $1 million worth of stablecoins, and you may go to the bank to cash them out, and they'll say, well, we're going to cash out about $600,000 of these, but the other 400, we don't like those. They're a bit dodgy. We don't really know where they came from. They may have been from drug dealers. We can't tell. So we're going to refuse your transaction, but we'll accept some of them. In other words, some coins are good, some coins are bad. There's kind of a gray area in between. I'm not saying this is good for society. In fact, I firmly believe that anti-money laundering is a complete waste and doesn't keep people from laundering money and doesn't help society at all, but you go to jail if you don't do it. So we're going to have know your customer and know the provenance of every stable coin that is a lot like money. In other words, if it can be redeemed, this is kind of my test. If it can be redeemed for the fiat currency, it's going to be treated as money. You're going to do anti-money laundering, not on every transaction, but anytime it goes into or out of the banking system. Does that make sense? It's not going to be easy, and it is going to be expensive, and it doesn't help society one bit. We're sliding back into the 20th century every day in crypto land. So again, the monetary policy is critical. The only thing here that is money is fully collateralized fiat. There are other ways to create other valuable things that may be stable and may have use in smart contracts as a store of value and so forth. But in general, the message here is, unless it is backed by dollars or pounds, and unless it has got all the right licensing and all the right machinery for interfacing with regulators, it's not money. Now, we are building a stable coin at Pillar, so inside the Pillar ecosystem, we will have pounds to start, and then we hope to have euros and dollars and more. And this slide, if you're interested, I can send it to you, and I just want to walk you through that. So a Pillar token holder, a Pillar wallet holder, and the Pillar wallet is free. You can send money to our bank account. We're starting a new company to do this. I'm just open sourcing what we're doing here. You can send money to our bank account. We will have an e-money license that we're applying for. We'll have a custodian agreement with a bank. And then you send money and we will put it into the bank account, including some extra money that we put in there just for good measure. And then we'll send you a token through a smart contract that will go to your Pillar wallet. You'll have pounds or euros or dollars. And then you'll be able to use that within the Pillar ecosystem to other wallet holders. You won't be able to move it out of the Pillar ecosystem. And this is a big difference between many of the coins. Some of these coins, they're like ERC20 style or Bitcoin style, and you can send them to anybody you like. And in many cases, the only person who has to do KYC is the last one who wants to then cash into the bank. There are issues with that. There are going to be times when you won't be able to cash that out because banks will be afraid that you are some terrible drug person or that they will lose their license, right? They don't necessarily believe it makes sense, but they have to comply. And so you'll use it within our ecosystem. It won't be able to leave. You'll be able to send payments, for example, transfers to people. Eventually we'll have smart contracts, we'll have P2P lending, we'll have all these things in pricing and e-commerce, and you'll be able to use it to buy things, and that'll be very good because when you transfer tokens, you're not using the banking system. So our goal is that you'll transfer any amount of pounds for 1 penny, any amount, $5 million, we don't care, it doesn't matter, or 5 million pounds, 10 million pounds, any transfer of 5 cents, it still costs 1 penny to do the transfer. And that's our goal. So we're trying to get out of the banking system and into the Pillar money system. But of course, we will keep track of everywhere every coin has ever been. So all coins are good coins and no coins are bad, suspicious coins. And then easily you'll be able to cash back out because of that. And the bank will say, sure, no problem, because we know where those coins have been. And you'll be able to get your money right back out through whatever banking partners we have. So lots of issues about money are going to come up. We're going to talk about them later. But stablecoins are here for use in smart contracts, for setting prices on the internet, for using price in transaction. They're going to be useful. I think that this is the year that many stablecoins will be born. The next 18 months we'll see a lot about stablecoins, and they're not money. Thank you.